One of my dad's mantras was in business, always outsmart someone, never screw someone, do business the right way. And I believe in karma. What goes around comes around. I get a dopamine rush when I outsmart people. That's just what business is.
What if the secret to winning isn't hard work, but outsmarting everyone at the table?
One of my dad's mantras was in business, always outsmart someone, never screw someone, do business the right way. And I believe in karma. What goes around comes around. I get a dopamine rush when I outsmart people. That's just what business is.
What if the secret to winning isn't hard work, but outsmarting everyone at the table?
I've put deals under contract for, let's say, $50,000, and I'll have a 45-day due diligence period and a 45-day to close. Well, in that due diligence period, I'm also exploring other buyers. If I'm able to get someone with a shorter due diligence period, put down $100,000, twice my $50,000. Well, now it's a risk-free investment. Money comes and goes, but no one can take your brain away from you.
Some of the more interesting conversations we've been having so far have been with people that are in the family offices space. And I think part of that is because by nature, they are a lot more private. And obviously, because it's family business, I would love your take on the differences that you see obviously you've worked for major public businesses, the differences that you see between working in a family office dynamic and a more public company dynamic. Obviously, they're just a lot more private, but I'd love to get into some nitty gritty of what the biggest differences are, because most people don't even know that family office is even an option. So I'd love
Sure.
to start
So
there.
I'll give you some background. So, our family office, we are primarily hoteliers, and we purchase distressed debt secured by hotels. We've done commercial real estate developments such as retail, office, but really like the hospitality space because it's liquid collateral. One fun fact is that within our state of India called Gujarat, uh, within a 60-mile radius, our Gujarati Indians own 60% of all hotels in America, and we contribute 4% to GDP with respect to growth, employment, and taxes. A couple of differences, my prior background, I worked in investment banking at Goldman Sachs in the principal finance group, investing the bank's money. But when I started, I grew up in the hotel business. Our families either bought or built over 140 hotels over the past 43 years. And growing up in the business, I liked it, but I didn't want to get back into it. I wanted to go to corporate America and learn and network. But ultimately, I moved back to Atlanta, Georgia from New York and got in the business. Now, why did I not go straight out of college to the family business? I definitely believe in going outside your workspace to learn, get some discipline and work ethic, as well as network. Some of those relationships that I built in New York are still relevant to me today, where I do business with a number of funds and private equity groups on the real estate side. You know, the main difference, walk through a couple is how family offices are capitalized. Typically or always, the capital is from the family office. And when I say capital, the equity. Now we'll go out and obtain debt, like on some of our hotel projects. We'll have banks and other lenders lend us money, but we will own the project 100%. So no limited partners, nothing like a private equity structure where there's a preferred return and then a split on a promote. We invest our own capital. Private equity, it's third party capital. So those funds will raise capital equity from life insurance companies, pension funds, and even high net worth individuals that will put their capital to work and basically delegate those investment decisions to a private equity fund. and they'll rely a lot on historical performance of those funds and the sponsors and the managers. Because effectively, you're buying into an individual to place your capital and you're placing your trust in them with no say so. Another difference is the investment horizon. Family offices are much more flexible capital. Institutional capital, they'll typically have a lot of constraints, meaning certain things you may or may not invest in, certain investment sizes, even leverage. A lot of the private equity funds won't take more than 60 to 65% debt for a number of reasons. They don't want to over leverage the business, but they have to put out equity. So the bigger equity checks they write, that goes well with their mandate. Their mandate when they're putting out this capital is obviously to achieve a high investor return greater than the stock market, because otherwise, why would you invest in a fund? But there is some sort of moral hazard in that they're putting out this capital, but they're getting 2% of management fees, whether their investments go up or down. So they collect the management fees, meaning they raise $1 billion fund, they're collecting 20 million guaranteed every year. And then they'll have their split on the preferred return and the carried interest. Whereas family offices, we invest straight down the line. So it's pari passu. There's no waterfall or any other hurdles. So we have a lot more flexibility in our event horizon. We don't have to exit an investment in 3 to 5 years. In some cases, we could take a longer stance, or in other cases, we could take a shorter stance. And we're not driven by IRRs and a 2-time return of capital. We are just driven in profitability and making money. The decision making is much more flexible within a family office. My bosses are my father and my brother, and we all collectively make decisions. Whereas with a fund or any other sort of institutional equity, you'll typically have a capital committee and an investment committee. And those groups will, similar to a family office, vet out the deal, the pros and cons. Um, but it requires a collective effort that takes time. Whereas we're much more nimble, we can make a decision immediately and within 24 hours start executing. So decision making, risk tolerance, you know, the institutional equity does have certain criteria and risk tolerances where family offices, we have a better stomach for hairier opportunities where we can see value. So we're not constrained by any means. It's fully discretionary capital to invest in any sector, different layers of the capital structure. So distressed senior debt, mezzanine capital, or the equity side. So that gives us a lot more flexibility. And then lastly, the operational involvement. We are heavily invested in the operations, the day to day management, as well as the asset management. Whereas a fund, they're making decisions from a corporate office, but they're not boots on the ground. They aren't physically rolling up their sleeves and trying to figure out an investment decision. Um, One negative about a family office is that, you know, we we are very small compared to those billion-dollar funds. And those relationships, the household names such as Blackstone, Carlyle, Sixth Street, people know about those funds, and they've got, I would say, deeper relationships than a family office. Whereas, family office, I put myself out there with lenders who have lent money to uh, us before, networking and auctions and bankruptcy. We go out and we hunt, but we eat what we kill. So the household institutions, do have deeper relationships just by definition, but on a level playing field, we think we're in a more advantageous spot uh, than those institutions.
That's super interesting because that's from the outside looking in, I would have thought that because it's family capital that you're more risk averse rather than able to stomach more. But I guess that makes sense. I'm also interested in, like when you said that you were if your bosses or your brother and your father, what it's like to do this type of business with family because it must be a totally different dynamic than what you experience at Goldman Sachs and GE. So I'd be interested to hear what that dynamic is like, not on a very specific level, but things that you've learned and how you can operate in that way. And maybe that's something that someone in private equity could learn from how a family office operates.
Sure. So on the risk tolerance side, just to the initial comment, yes, we do have a deeper appetite for risk, but it's also risk adjusted, meaning there may be certain hotel or distressed debt opportunities that, a fund may look at, but we have a lot more flexibility and we believe we understand the asset the same, if not better. So it's calculated risk um, on that side. With respect to working with family, of course, it has its nuances. You can always choose your friends, but you can't choose your family. But I'm fortunate that um, my father's really instilled certain values in myself and my two younger brothers that we make it work. Now, um, do we have we ever had conflicts or disagreements? Yeah, that's natural, but it's always they're always addressed because you still have that familial relation, and it's unconditional love, meaning we respect each other's views, but again, there is that incestuous nature where they are your family, but they're also your business partner. And some family offices don't make it work, right? There's first generation, second generation, and there's a saying about the third generation. A lot of the siblings or grandkids may have disputes and they unwind their offices. There's very few businesses that have gone third generation and beyond. You could take, for example, an automaker like Ford. That succession planning has kind of been an anomaly in the industry. A lot of businesses don't that are backed by family offices don't really make it past the second generation.
That's super interesting. Like when you mentioned that there's certain values that pass down, so it's almost as the if I'm understanding what you're saying correctly, the true test of whether a family office will last are the values that you decide to focus on and instill throughout the succession in a short sense.
Correct. So parents were immigrants. My father was born in Uganda in Africa and was forced to leave by a dictator called Idi Amin. So his family had to leave all their possessions and belongings in Uganda and he immigrated to London, whereas my mother was born in London. So my dad has seen a tough life, and he's also self-educated, self-made. Did not go to college, just didn't have that opportunity in life. So a lot of the ethics that he's grown up with have been instilled in us, primarily hard work. Money comes and goes, but no one can take your brain away from you. So he's instilled in us education, education, education and a lot of those values transcend to the next generation with his grandkids, meaning myself and my brothers were fortunate to grow up with um, values, high values, even little things like being on time. Um, those things I've tried to instill in my children, just as my father did me, and hopefully kind of replicate that going forward throughout the family.
That's super cool. So, one, you mentioned hard work, education, education, education. What are the other values that you would say make up the Patel family office?
I think networking, being personable, you have to put yourself out there to originate these deal opportunities, right? Life is short, and we're only here for a limited amount of time. So you have a choice who you want to do business with. Do you want to do business with a nice guy, or do you want to do business with a not so nice guy? And life's too short to pick the latter. So, you know, you've got to be personable. You've got to get along with people. You've got to listen more than you speak. So little things like that, I think, have accumulated into this kind of holistic model where certain attributes you try to exemplify, and others you you're dissuaded from because they're just not conducive to doing.
I'd love to kind of rewind the clock and hear a bit more about your background and your story and your thought process from you mentioned like growing up in the family business and then wanting to go into corporate America. I'd love to hear kind of the decision making process as you went through different opportunities and then like kind of how you came full circle after everything you learned in corporate America and just kind of like what that was like coming back and what you've been able to bring back to your family business.
Sure. So growing up in the business, my father was the first Indian to own a Holiday Inn. And as I said before, 60% of all the hotels in America are owned by Gujarati Indians. You know, when my father came to the country, he was 20 years old and bought his first hotel, Holiday Inn, at 21 and in 1981. And this is when interest rates were 17%. But he put all of his life savings into that hotel and rolled up his sleeves, as did my mother. So, being the general manager, being the cook in the restaurant, being the maintenance person, being housekeeper, you really have to do everything. And when we moved to the country, we literally had a double wide mobile home that we lived next to the hotel. My dad had grew from that. He had a lot of contracts with CSX, the railroad. So hypothetically, for a 100-room hotel, if you're able to use 50 rooms a night from a company such as CSX Institutional Credit, you can fill your rooms and pay your debt service, and every other room you rent after that, you yield manage for a higher rate, but at least your downside's protected. And the other thing about railroad workers is that they only work 8-hour shifts. So in theory, you could re-rent that room and clean it in one day. And now you're doing 200% occupancy. So getting creative and ingenuity, which is the backbone of being an entrepreneur, that served us well. Then my father went to Montgomery, Alabama, Nashville, Chattanooga, Tennessee, and then Atlanta by the time I was 13, which was the CSX loop. Uh, in 1996, my family did very well. We owned 11 hotels at the Atlanta airport. So one out of every three rooms was ours. And the Olympics was a big boon for Atlanta in that uh, getting creative, some of these corporate contracts would pay you 2 years in advance. So if someone's giving you 2 million upfront to reserve rooms for the Olympics, well, guess what we did? We parlayed that capital and bought another hotel using their cash as our down payment, and then get more contracts and replicate that. So just being an entrepreneur and thinking outside the box, how do I grow my portfolio in a creative way, but also understanding the risks that go along with that. So when I grew up in the business, it wasn't very attractive to me, right? I didn't want to operate a hotel. I didn't want to be the maintenance man or general manager. Not that I would be, but I just didn't that wasn't sexy to me. And in high school, I'd watched this movie called Wall Street with Charlie Sheen. And I was very intrigued. Even though he was a stockbroker, I was more interested in the investment banking and principal investing side. So I moved to New York City when I was 17. I attended NYU for economics and London School of Economics, finished in 3 years. And then right after I graduated, 9/11 had occurred. I graduated in 2002. So a lot of those interviews and jobs on Wall Street literally retracted and rescinded their offers. So I was kind of frustrated in that I went to school, NYU, London School of Economics, and I was having difficulty obtaining my first job. My father was a large borrower with GE Capital, and I was fortunate to meet the CEO at that time, Jeff Immel. And Jeff, I had a conversation with him, and he said, "Son, what do you want to do?" And I told him, "Sir, I just want my first job." So he said, "What do you think about securitization?" I said, "Sounds great. I'll sign up." I had no idea what it was. And it's surely financial engineering. So GE and GE Capital were one company at the time, and GE was the industrial manufacturer. So they made aircraft engines, had small business loans, they made hospital equipment, they had credit cards. Pretty much every business you could think of, GE had. And then GE Capital was the financing arm. It was their captive financing. So let's say there was a portfolio of $1 billion hotel loans. Those loans are yielding principal and interest payments every month. So what we did, we sold that risk through two forms. We either sold those loans into a commercial paper conduit, so you can pledge assets in a credit facility and take your capital out and then make new loans and make new loans. The other form of securitization was asset-backed securitization. So we would actually issue bonds backed by those loans. So I was decently good at Excel. I became much better in that I was modeling cash flows from loans and structuring them into senior and subordinated bonds. And GE would typically keep the last tranche, the equity, um, and there was a much higher yield on that. But for example, if I had $1 billion of loans that were yielding 10% average coupon, and then you do the historical analysis on prepayments and defaults, which you can quantify through the rating agencies, that certain loans over time, when they're originated, behave differently. So some loans that were originated in 2007 at the height of the market, well, in 2009, those tanked. But in better credit periods, those bonds did well. So I helped structure the bonds, model the cash flows, and then work with our investment bankers, who at the time was primarily Goldman Sachs. Goldman has a long-standing relationship with GE and took the company public many, many years ago when Thomas Edison invented the light bulb. So I learned a great deal in how to hedge those bonds through interest rate swaps. So if there were a portfolio of 10% floating rate loans, we would buy an interest rate swap and fix that. So now I'd have 10% loans, but I could issue 92% of the capital structure. So 920 million of bonds at 2%, right? So now the net interest margin, I'm yielding 10. I may lose 2 basis points or 200 basis points. And now I'm netting 8%, but I could issue debt at 2%. So now there's a 6% spread on a billion. So that's 60 million of income every year that we had those bonds in duration. So if it were a 7-year asset, such as auto loans, for example. We would make 60 million a year discounted back over 7 years. It was a couple $100 million profit that we were delivering for GE. And it was a great job. Um, but after spending a year in Connecticut, I was really missing my friends, the social life, the hustle and bustle of New York, and wanted to get back. So I was fortunate to join Goldman Sachs, who were our bankers. I had 5 rounds of five. So I had 25 interviews just to get an offer. And part of that goes not just the selective nature of the company, they want to hire the best that they can. But, when you're working long hours with people, I would get into work at 9:30, but I would leave every morning at 2, 3 in the morning. Right. And you're going 7 days a week. You're working north of 100 hours a week. So now you're spending more time with your colleagues than your significant other. At that time I was single. But a lot of the guys that had married life, they really didn't have that work life balance. They were working all the time, being away from their family. Um, so you've got to get along with these people because you got to be well rounded, not just a numbers person. You've got to be able to talk about sports or other things that because these people really become your friends. You're spending so many hours with them. Um, a lot of the things I learned at Goldman, they had, when I joined, their list of 10 rules, and you kind of memorize them in the analyst investment banking program. But two things I really took away: a lifetime takes a second, or a reputation takes a lifetime to build, but 1 second to lose. And, Goldman's relationships, it was all vested in trust and your reputation on Wall Street. So again, a reputation takes a lifetime to build and a second to lose. And then the other thing is be low key. Nobody gets paid for fame. Don't be on the cover of the Wall Street Journal because you're gonna attract unwanted attention, right? Not everyone out there is a well wisher. There's some people that get jealous or other things. So with our family office, I'm able to generally keep a low profile without much exposure and operate. And those two things have served me well.
That's
That,
fascinating. Yeah.
yeah,
That
that's an insane story, man. To hear about the Atlanta Olympics and how your family that helped. A week and a half ago, I joined a buddy of ours, Kevin, up to Colorado Springs, and I met he's 96 now, 95, 96. He was the head of the US Olympics at that time. So he would tell me stories about putting the Atlanta Olympics together, um, in Germany and all this other stuff. So it's crazy to hear how small the world actually is in terms of how like you said, your reputation takes a lifetime to build and a second to take away. But part of reputation is the actions that you're taking. So it's crazy to hear how one man's actions just create this ripple effect. And then here's your family office today, and we're having this conversation. So I just wanted to make that note. DJ and I had something to say, but that's just amazing to me.
Sorry. And yeah, work for me is not work. I genuinely and passionately love what I do. It's fun. And so I encourage people that don't go chasing the dollar. Do something that you're passionate about. And if you love it and it's fun, it's not work. And if you can make money doing it, that's great. That's the best job that you'll ever have.
Definitely. Yeah, you mentioned kind of like earlier in the conversation, the differences between family office and private equity and how you have like complete optionality and where you can allocate the capital. And I'm assuming the answer to my first question, which is why hotels is the deep roots in hotels and the years and years of experience. But like if you could expand on that, like what competitive edge do you guys have in hotels have after being in hotels for so long across multiple generations? And just why do you still invest in hotels? Is it because, like, that deep specialization is just such an edge? Like, I'd love to hear you just kind of expand on that.
Sure. So, one thing to your point, I stick with what I know. meaning I don't invest in the tech space um, because I don't want to learn a new business or whatever it may be. So I grew up in the industry, and as you know, hotels are an operator business. So there's a lot of arbitrage with a bad operator or a property that doesn't have enough capital expenditures to maintain a Marriott, Hilton, Hyatt, or IHG flag. And then within the Indian community, because we own 60% of all the hotels, it's very liquid collateral for me, meaning when I buy a hotel, I can exit my position because you probably know several Indians in that market. Or when I buy distressed debt, I know about the asset and our community. It's not the traditional 6 degrees of separation. It's like two, no more than three. We always know someone who knows that person. And with that, you can really size up the person. Are they a good person, a borrower, or are they a bad person? And you kind of know um, how to approach that investment decision going forward. So it's very liquid collateral. If I were to buy a distressed loan, and if I can't go into a forbearance and get refinanced with the borrower, I'll foreclose. When I foreclose, we put in better management. We'll invest in the property to bring it up to par or upgrade their franchise to a Marriott, Hilton, IHG, or Hyatt hotel to really create value. So, hotels are valued off of cash flow, net operating income. And with a poor borrower, poor manager, you can have someone really run down a hotel, whereas you can step in, create a lot of value overnight, and exit, right? And when I say overnight, that's figuratively speaking. We'll hold on to it for a few months, bring up the cash flow, and then list it with a broker. Um, and there's probably an Indian in that market that'll buy it at some price, or we'll refinance through the non-recourse CMBS market to remove our personal guarantee from the loan, take our equity out, dividend that out, and clip a cash flow coupon. Um, but again, it really depends on what the asset is. And when we're buying distressed debt at a discount, that's the first senior level in the capital structure. So when we buy that at a discount, the equity is blown out. There is no equity. Or if there is equity, we're in an even better position. So buying the debt at a discount, the only thing that can prime you is property taxes. So we'll do our title search and see what liens are on the property. But we stick to hotels. Long story to a short answer. We stick to hotels because it's what we know. And for us, it's very liquid collateral.
I'd love to follow up on that question, which is, you mentioned like it's an operator-led business. So what are some things like if you're valuing a hotel or you're looking at a property, like what are some low-hanging fruit that you're instantly able to just notice based on how, how the hotel is being operated, where you guys are able to see, an instant value add that you can come in and make a few tweaks? Like is it yeah, I would love to just hear your opinion on that.
Yeah, no. So when we come across hotels, we also know what the brands are looking for, meaning the exterior corridor hotels where you drive up and you enter into your room, those have gone to the wayside, right? Those are more your economy budget hotels. And we look at it that it's more of a land play than a hotel play. So if the real estate is good, we'll take a look at it. But again, for a number of reasons, that's not where consumers want to stay. And in some theory, we are under demolished, not overbuilt. So there's a lot of scratch and dent product out there that simply just needs to be demolished. Now, when I say what we look for on the brand side, we look for interior corridor boxes. So you come inside the hotel and you enter into your guest room. Those hotels, one, they're safer from a life safety perspective, and that's very big to women travelers and families. And then we also look for no less than 3, but preferably 4 stories and higher, because those boxes have an economic life much longer. You can do a lot more, and brands are willing to flag or franchise those sort of boxes. So we like interior corridor properties, 4-story, and a decent box. Now we'll go in and renovate those assets to try to create value and then exit. We also like doing business in the suburbs. So we had we turned a Flatiron triangle office building into a Marriott Courtyard, 150 rooms, and we sold shortly after opening to a public REIT, but and did very well on that investment. We got 2010 historic deal of the year and really tried to optimize the capital structure. But we don't like doing business in urban areas because you can get the same rate in a downtown CBD as you central business district as you could in the suburbs. Meaning, if I were getting $160, $70 a night in downtown, in the suburbs, I have a better labor force, a lower payroll, people who actually show up to work. And I have lower property taxes, lower utilities, lower insurance. And even if I'm getting slightly less than a downtown hotel at like 150 a night versus 170, I'm still having greater cash flow in my pocket because my expense factor is lower. So we like picking out secondary, tertiary markets and being one of the few games in town, and certainly the newest game in town. And consumers just have a natural inclination. Would you stay at a new hotel or an old hotel? So those properties do very well, and that's kind of where we invest. But 4-story interior corridor box, um, outside of a major MSA in the suburbs. That's generally what we.
So if anyone or myself or DJ ever come across a 4-story interior box, the tertiary market will ring you up for sure. I and it's so what's so interesting to me is to hear you say that once you buy a property, you likely will know a buyer just because of the 60% number that you said. It's so interesting to me because of the I don't know if it's a cultural difference, but when you say something like that, me being Mexican, it's like that is true for Mexicans as well, but not with hotels. It's more with like trucks, like pickup trucks or something like that. So it's just so interesting how it's literally like the same game. It's the same, fix and flip a truck, fix and flip a storage yard. I have a cousin that does that. Fix and flip a landscaping thing, equipment or something like that. As funny as that sounds, but the it's so interesting to hear that it's this literally the same economics of it, I guess. But it's just a much higher leveraged asset than that's so interesting how that ends up playing out. Um,
Yeah. And so, it's the typical immigrant mentality. The US is the best place in the world. And that's why our parents came here as immigrants. They left their home country, wherever that may have been, in search of the land of opportunity. The US is so vast. There's so many markets um, in that, and then the immigrant mentality, why the hotels are owned 60% by Indian Americans. There's actually a trade organization, if you check it out online, it's called AHOA, Asian American Hotel Owners Association, which is AAHOA.com. And right on their front page, it'll tell you there's 20,000 of us. We own 60% of all the hotels. But why is that? When our parents came to this country, they needed a place to stay and a business. So guess what they did? They bought a mom and pop hotel and lived in the hotel, right? You killed two birds with one stone. And the next generation has parlayed that. Back in the 80s, there was a lot of racism towards our community because there was the stigma. It's a chicken curry motel, right? You walk in the motel, the lady's cooking curry in the back. And, we in the 80s, we used to have signs that said American owned. And it just kind of boded to that racism towards our community. It was hard to obtain loans from lenders. It was hard to obtain insurance, but the second generation has parlayed that wealth into nicer properties, Marriott's, Hilton's, Hyatt's, IG, and even got in other sectors of commercial real estate with their wealth, self-storage, office, retail. And there's some guys throwing excess capital into venture capital.
That's so cool because it shows the importance of the community, of a community being out there. It shows, like you said, AHOA, if I'm pronouncing that correct. It it shows how important that is and how that's good. It shows that you're not the only one that's doing this. And then here it's like you share the secrets and share that. It's a mastermind essentially for that's just really cool. I just wanted to point that out as
And the
not true.
distribution. So, like, that's one thing I wanted to point out was we had a conversation with another guy. His name's Kerry Ransom, and he owns a company called Bank Tech Ventures, and he basically has like a fintech relationship with tons of banks, like small banks, and then he also has like a venture arm where he invests in fintech companies. So he already has the distribution. So it's like how you already have a buyer before, like if you're going to go into an investment, you have a buyer on the other side if you do X, Y, and Z. It's similar to his investments. They're almost de-risked because he's investing in it's like a venture investment, but he can validate that idea with a potential customer. So it's kind of a similar concept with that community. You have built-in distribution to where you're able to, like you said, flip these hotels in a matter of months or years, whereas other people would not be able to do that.
Yeah, no. So, just that ingenuity, there is kind of, and we'll talk about this later, but there was the saying that it takes money to get in the game. Well, not necessarily if you get creative. With respect to the distribution, I've put deals under contract for, let's say, $50,000, and I'll have a 45-day due diligence period and a 45-day to close. Well, in that due diligence period, I'm also exploring other buyers. So if I'm able to get someone with a shorter due diligence period and put down $100,000, twice my 50,000, and give him 30 days due diligence and 30 days to close. Well, now it's a risk-free investment in that I am literally flipping the contract at the closing table, doing back-to-back contracts, and I don't even have to own the property, right? And if the buyer doesn't close and I lose my 50, well, I've got his 100, so I make 50, right? And just thinking about how to get creative in that light. But the distribution plays a huge part because it allows me to get out of my position.
Could you break that down a bit more? So you're explaining you're going to put down, say, 50,000 on a property, go into a 45-day due diligence period. Can you just expand on how does that other buyer come into play? And can you just break that down?
Sure. So within the purchase agreement that I negotiate, you'll have typically a right to remarket the property. If not, you should draft that in there. So let's say day one, I put down $50,000 and they put it in an escrow account. I'll put down in the purchase sale agreement, I'll want 45 days due diligence, right? And then I'll say a 90-day closing period. So I had 90 days to close, but on the 46th day, my 50,000 goes non-refundable. Now, on a parallel track, I'll obtain a buyer to buy that asset, but with a shorter due diligence period and a shorter closing period than I'm under contract for. So they have to perform in 30 days, whereas I have 45. Now, if they don't perform on the 31st day or cancel their contract, I still have 15 days to cancel my contract and get my 50 out, right? But if they go non-refundable on the 31st day, that 100,000 is in the trust account, but that's my property, right? They've gone non-refundable. and they will close. Say on the 89th day, they do not close, which means I do not close. Their 100,000 is forfeited to me, and my 50,000 is forfeited to the seller. So I lose 50, but I also make 50. And the buyer that we're flipping it to is out 100 grand, if that makes sense.
Yeah, that's super interesting. It sounds like you've got tons of different creative, Ivan, I'll let you go in a second, but tons of different creative ways to de-risk your investment. Because you were talking about, you know, Ivan brought up the point that like, hey, you're a family office, so you would think that you would have kind of like a you know, less risk tolerance, but you were saying that you can go into what, you know, an investment class that maybe a fund would view as risky, but for you, just due to like, you know, the competitive advantage, how long you've been in the industry, the connections, the network, the distribution, and I'm sure a lot of different creative tricks up your sleeve. It's de-risked for you. I'm gonna let you go, but I just thought that was a really, yeah, really interesting point.
Oh, yeah, yeah, it's I've heard of people, they call it, like, wholesaling, like, getting a house under contract that's distressed and then finding a buyer and then just keeping the client and just making money on that. I didn't realize you could do that with multi-million dollar hotels.
Well, that and, I've seen my father, well, one, flip contracts, and I've learned his ingenuity on back-to-back closings, but on the second, wholesale to retail strategy. My father, with his relationships, at one point bought 8 or 12, La Quinta Inn and Suite hotels. Well, while he was under contract, he had already pre-sold 8 of those for his whole investment. So now he has 4 hotels for free, right? So the sum of the parts is, is greater than your going in value. So you can buy wholesale to retail as another stream.
I mean, I didn't know if you had a follow-up for that, but that's yeah, that's so interesting. What are some like I find it really interesting because you guys have passed these tricks. Obviously, your father had to go out and learn these tricks, I'm assuming, because it sounded like, you know, you guys were living in a double wide as immigrants, and then, you know, he's built this wealth and this system and strategy within a very, you know, specialized vertical and niche. What are some I guess you could say it's like these are things that you wouldn't learn in school. Like, what are some things that you've learned through just experience and getting creative and being in like, you know, having ingenuity as an entrepreneur and watching your dad? What are some other super, I don't want to say counterintuitive, but just like tricks of the trade secrets that you guys have built over the years and years of running the family business?
Yeah, no. So in New York, there's such thing as book smart and street smart, right? You can go to school, you can learn everything, but street smart is something you just have to have an innate knack or learn the hard way. And I think on the job experience, nothing beats that, right? You don't have to go to school, but you could run circles around the next guy because you have more street smart. You know how to hustle. Yeah, book smart is very important, but I'm blessed to have my father still here. I spent 10 years in New York, and that was part of the reason I moved back. In that, your parents aren't always going to be here, and he's been a mentor to me. He's the smartest man I know, and he's self built. Um, 140 hotels. He started 3 banks um, with no college education. He started an insurance company, property casualty agency, and then a reinsurer captive in Bermuda. And then when I left Goldman, we bought a company from the Blackstone group called Budgetel. And now we're a franchisor of 90 hotels. Nothing in school will teach you that. It's being around those those people that add value. And in my case, it's my father. There's a saying, you are the company you keep. And it is true. You just got to be a sponge and never stop learning. The second you think you know it all, that's when the problems happen. So I love reading. I love learning. I love listening to people and just trying to be a sponge. But nothing beats on the job experience. That's where you'll learn how to apply whatever your book smarts are into the real world. And frankly, that's all that matters, the real.
That's so cool because What's exciting about nowadays, and I had this realization, and as we were starting this podcast, um, is that the book smarts is now available to everybody for like $20 a month with GPT. It's the most amazing thing that now you can start playing games that don't like you can outsource the getting of the book smarts and then just rely and talk to purely street smarts, and it's so exciting because you it opens the it opens your perspective to what's even possible in terms of what games you can even play. And to hear you say that is very cool because it's man, this is an exciting conversation. Sorry. That's all I could say to what you just said.
Definitely. I was gonna add to one thing. You mentioned a value, like a core value in your family business is education, education, education. Yet your father's not traditionally educated. And we've run into just a wide, I guess, in the interviews we've done, there's people that are in the industry that are very traditionally educated. And then we also have like a close buddy of ours who's dropped out of high school and is now in private equity doing roll-ups in different industries. And we've found that, you know, I just love that education's such a value for you guys, and it's self-education because clearly your father's a self-educated person, and there's people who would become traditionally educated and then stop their education after they're traditionally educated. So, that wasn't necessarily a question, but just kind of a comment because we find it fascinating just talking to the people we've met who've gone to the highest levels. They're just people who are obsessed with learning, and, if you're not learning, you're dying. That's really a value for it has to be, or you'll become obsolete.
And one of my dad's mantras that he instilled in us was in business, always outsmart someone, never screw someone. And there's a big difference, right? Do business the right way. And I believe in karma. What goes around comes around. And I get a dopamine rush when I outsmart people, right? That's just what business is. Um, so there's two ways to do business. And I just try to do business the right way, how my dad taught me, and outsmart people, but subtly, right? You can't have an ego. Um, but I think that's the really cool thing is when you're sitting on the other side of the table with someone, just trying to outsmart them. It's a really cool.
I'm so I'm gonna need some help from you right now because I when it comes to the outsmarting piece, the outsmart someone to versus not screwing them over, there's a very big difference. Can you expand on the outsmarting of someone? Because for I don't know what it is. Sometimes for me, I'm like, well, I know how simple this could be, and they don't want to just tell them. Or I don't know if that makes sense when I explain it that way, but when you think about outsmarting someone, what is the line that you draw that you don't cross when it comes to outsmarting someone versus straight up, this is screwing them over?
Yeah, no. So, um, when a seller is selling a property, there's a price for everything, I believe. Everything has some value. In some cases, or most cases, when I'm buying property, I'll point out the negatives, right? And at least bring their expectations down on pricing and why they should sell this asset to me. But then I'm selling the dream on the other side to the next guy because I saw the value and I'm just outsmarting the seller. He doesn't know what he has. One man's trash is another man's treasure. And I'm outsmarting them. Even in legal situations, I'm not an attorney, but when I'm drafting legal documents, everything there is for a reason. And so there's a saying, you out lawyered them, right? You're just outsmarting them. So there's different ways it can come, but I'm doing it the right way as opposed.
You mentioned outsmarting the seller, and you guys have obviously you mentioned, acquiring a brand or property, a franchise from Blackstone. So I would love to hear if you could, I don't know how detailed you can get, but kind of walk through that deal. And what did you see in the deal that Blackstone didn't see? Because I think that'd be a very fascinating story for you to share.
Yeah, I know. So in 2007, 8, we bought a company called Budgetel. Budgetel had 200 hotels in the Midwest. It was founded by the Marcus family. And in the 70s, they were the first hotel brand to do continental breakfast. They would literally put a donut and a coffee outside your door. And that was continental breakfast. But then Blackstone And those properties had converted to a Baymont Inn, which La Quinta had purchased. When Blackstone did the leverage buyout of La Quinta and the IPO, they had this asset on their balance sheet with 0 properties. So we bought just the intellectual property, because we felt there was a need for a franchisee-friendly brand in the market. When you sign up franchise contracts, you pay royalties and all sorts of fees. But if you terminate that contract, there's a provision called liquidated damages, which are basically make whole agreements. And all of these brands, they're selling their growth story to Wall Street, and that's how they finance themselves. So if a contract terminates, they're going to get their money one way or another, right? Either through personal guarantees, liquidated damages, and that's really not the right way to do business. If someone's down on their luck, work with them. Don't try to take them to the cleaners. So what we saw in Budgetel was this brand, no properties, great name. It says what it is. It's a budget hotel, a budget motel, self-explanatory. So we wanted to make this as a franchisee friendly brand with annual contracts, not 20-year agreements, no liquidated damages, and you get what you pay for. So instead of taking off top line, how all brands do, they take a percentage of gross revenues, typically anywhere from 6 to 9%. Well, they're in the risk-free position. They take their money off top and not the profitability. So we wanted to say, okay, we're not going to have a variable fee structure. We're going to have a fixed fee per room per month. So let's say 100-room hotel, $30 per room per month. That franchisee's only paying me $3,000, $4,000, and that's great fixed income. Whereas opposed to a true franchisor, institutional franchisor, they would take off the top line. So their fees are 3, sometimes 4 times higher than ours. And what do budget motels, hotels want? They already have their drive up customer, but they want a reservation system, right? So you go to www.budgetel.com or call the 800 number, and we have a lower fee versus our competition on reservation bookings. So I believe our fee is like 7%, where a lot of the brands, such as OTAs, they're online travel agents, the Expedias, the hotels.com. They have a fee of anywhere from 20 to almost 25%, whereas we're at 7%. So really trying to create value for our franchisees. But with the annual contracts, once someone spends 15, 20 grand to change their sign to Budgetel, they're not going to leave you the next year. It's a very sticky business because they've made that investment up front. So really understanding the competitive landscape, we get in where we fit in. And we know we're not a Marriott, Hilton, IHG, or Hyatt, but we don't want to be. We want to be a flexible brand, and there's a market out there for those conversion properties that are getting B licensed by the major grants. Where do they go? They could go and call themselves Ivan's Motel, or do they want some sort of name brand with some consumer recognition, basic brand standards? And we knew there was a market for that. I believe at one point, IHG was terminating 100 Holiday Inn Expresses. Well, that's perfect. That's low-hanging fruit for us. We want to convert some of those properties. We are not a new build brand, even though we've had, I believe, 2 or 3 in Texas by the oil fields. But we're a conversion brand, and we're not. It's not the most glamorous business, but it's certainly a feasible business.
That's man. So you essentially found a gap, a need in the marketplace, found a solution for it. You align the incentives, and then you attack. That's man. The aligning the incentives has been a very interesting principle I keep running into. There was this guy I binge watched a bunch of interviews. Palmer Luckey of Andrew, um, and he basically said that's essentially how he has been able to scale that company to billions and millions, billions of dollars to somehow crack into the top 5 of defense contracting because all he did was just align the incentives where there was an opportunity to. And the fact that that's how you also, in a sense, outsmarted Blackstone. I mean, that's a good headline for us, but that's
Never,
super interesting.
never buy from Blackstone. They're still the smartest people in the room, right? But no, it is what it is. We saw something that they did not, and frankly, they're on such a high level. They didn't want to mess with this, right? It was a non-core asset for them, and to get some money was better than having a non-income generating asset on their balance sheet. So it worked for both parties.
That's very cool. Is that the biggest deal you've been a part of and that you've seen? What is the
No,
biggest deal?
yeah, we're actually working on one right now. Can't disclose, but on some I've bought I guess there's $21 million of $23 million of loans we had bought for um 5.7 million. I had purchased that with a loan from a bank for 4 million. So we put in 1.7 million and we knew the collateral. One was 181 acres that the Gwinnett Department of Transportation was condemning through eminent domain. They were going to run this road near my house called Sugarloaf Parkway through this property. Well, the seller, RBC Bank, wanted to get rid of this as far as acquisition development loans in April 2008 when the market was falling. They had bought a bank called Peachtree Bank and they'd written down their loan portfolio, but wrote up the goodwill on their asset side, what they paid for the bank. So this loss of 17 million never hit their profit and loss statement and affected earnings for their stock analysts. So that 181 acres got condemned. Within there was a payment upfront of, I believe, 3 million. And again, we only paid 5.7. So we got 3 million out. And then 9 months later, in condemnation, you'll sue the county and you'll get an appraisal and all of those things. And we collected a total of 11 million on that 5.7 investment. So that 1.7 million equity we put in, we made 4 times our money. And then on another loan, we had an office warehouse that we foreclosed on and sold for 1 million. So that was pure profit. And then we had 151 acres where there was a Colonial Pipeline pumping station. So we had bought that loan and we had a lender's title policy, but there was deed restriction with respect to potential contamination of the property that was missed in the title. So we pulled title, we saw the existing lender's title policy, and the property was not insured for what was on record, on public record. So we sued the not the seller, we sued the Colonial Pipeline, we sued the title insurance company, Old Republic, and after probably 6-7 years of litigation, because the goal of an insurance company is to wear you out, we obtained a jury verdict for 17.2 million. So on a 1.7 investment, we realized about a $15 million profit or so. And again, that was with our own capital. And it was just a fun deal because we created case law in Georgia. In Georgia, an owner's title policy goes into effect the date the property was bought and the loan was made. Well, on a lender's title policy, coverage only kicks in if you foreclose, not the date the loan's made you're insured of. Well, in Georgia, you have election or remedy. If the property is contaminated, you don't want to own it. There's huge liability with the EPA having to remediate and clean it up. So you can sue on the note, multiple other things. So we didn't foreclose, and just getting creative on, how to create value. The other thing is Georgia is a deed to secure debt state, not a mortgage state. So a deed to secure debt, you have an ownership interest in the property. So we should be treated like an owner's title policy. And we created case law on that because, like I said, you may not want to foreclose, or in a rising market, if you foreclose, you're able to sell it for more than your loan amount. So there's no damages. And in the falling market, if you have to foreclose, well, now you're foreclosing at such a low amount and you're taking the back. So the insurance company always wins, but we were able to set case law in Georgia uh, on that matter.
I don't know if you had something, Ivan, but you've mentioned like just so many different examples of like creative ways to structure deals and finance deals and de-risk yourself. Like, were these things you learned when you were at GE and Goldman Sachs, or have these more so been through like, like you were talking about, boots on the ground experience, doing deals with your dad? How were you able to learn all this, you know, financing structure?
Yeah, no, it's on the job experience. Goldman and G taught me how to underwrite deals, how to look at them, but just working with my father again, the best mentor, and I've learned so much from him, what to look for, as well as the people I keep company with, meaning my attorneys. I have some rock star attorneys who I've learned a lot from, and just through my real estate attorneys, my litigation attorneys, my father, and just experience. It served me well.
Man, I've learned a lot today. And who knows, maybe we get your father on one day. Get get some gangster stories or something like that for us. But I wanted to say, um, in order to respect time, I just want to say thank you for the time that you spent today. And thank you for the stories and everything we shared. We could easily keep going for hours and hours. I don't know about you, but I know I speak for DJ and I. We could easily have continue this conversation for another few hours. But um, if someone does have an opportunity that they'd love your eye on, or if someone does want to reach out to you and get you involved into a deal somehow, what is the best way to reach you and look out for you?
Yeah, no, I'm always happy to talk to anyone, right? I've always one thing my father's taught me is you're never too good to anyone for anyone. Meaning, we treat our housekeepers, our housemen, we pick up garbage in our own parking lots. You're just never too good for anyone, and you don't know where those relationships may take you. So I'm happy to speak with anyone at any time. Best way to contact me is via email. It's the letter JAY at jmsfamilylp.com. That's JAY at jmsfamilylp.
Sweet, beautiful. We'll make sure that that is included and that people can read that. And Jay, again, I just want to say thank you for the time.
Yeah.
And
Thank you for your time, Jay. That was really fun conversation. Definitely going to be throwing the transcript script into GPT and buffing up my capital structuring chops. But yeah, thank you so much for your time.
No, it's my pleasure. Thank you for having me. It really means a lot. Thank you, guys.